and welcome to Options Guide TV. My name is Brian Overby. I'm the author of The Options Playbook, and I will be your host for about the next 25 minutes here on Options Guide TV. All right, so we're still in the heart of earnings season. We have quite a few companies that are going to be announcing. We're going to look at Uber because they're going to announce before the open tomorrow. And I don't mind getting a little bullish on Uber. So we're going to look at one of our skip strike butterflies. It's about $100 stock. I don't mind the math that's on it. It's got a little bit of vol in it. So the butterfly is fairly cheap relative to buying the options outright. Then we have McDonald's before the open on Wednesday. And I think that's going to be an interesting one to listen. I always like to hear McDonald's is a well-run company. They've struggled this year relative to anything AI, right, so far this year. And it's always just good to see, like, what are their thoughts on the consumer? And, what do they have to do to sell some more Big Macs and everything that goes along with it? So they always have fairly decent insight. So I always like to listen to that one. And then we get to the end of the week. Open Door is going to be announcing that kind of goes a little bit with, the whole craze of food delivery across the board. And then we got Airbnb. We have AstraZeneca on the pharmaceutical side of things, which that is also an interesting stock. And then we have Rivian that's going to be announcing on the 4th, and they're going to I want to get short some Rivian going into that announcement. So I'm going to do a very simple short, long put. Mainly it's a low price stock. And I do think I kind of feel bad for the EV space, but it is really getting beaten up as of late. Ford announced their sales, and they almost across the board talked about slowness in the EV space, even in the hybrids a little bit. Ford has done well, though. Just in general, the automotive marketplace is doing fairly well, but Rivian being 100% EV, kind of nervous. They're also dealing with tariffs, rare earth issues. There's a lot of headwinds for Rivian going into this earnings report. So I'm going to get, even though the stock's been beaten up, I want to get short Rivian. So today we'll start by looking at the trades that we just put together just the other day. We looked at Chevron, CVX. We looked at Amazon, AMZN. And we did some short put spreads. So let's start by going to the short put spread side of things. And we'll pull up Amazon. So Amazon has done well because they had a big announcement today. They did a big deal, and they're up again after their earnings report. So with Amazon, we did a short put spread, and we might be able, but we went out 14 days, and our goal was that we're either going to adjust it or roll it by Friday. But at this point in time, it's up enough that we might be able to just either close it or roll it at this point in time. So what we did in Amazon was we sold the 245s. Yeah, we sold the 245s, and we bought the 240s. We made them all 5 points wide. And we went out 14 days, which is now 11 days, to November 14th. And at this time, we sold the 245s and bought okay, there it goes. It's finally opened up. Okay, 245s and bought the 240s and did it for $2 on the 14th. So 245, let's sell that one. And 240, and we'll buy that one. So we're up 50% on the trade. So we could easily close this trade and move on. Or we could roll it up, and I don't mind rolling it up. We'll probably wait till Wednesday to do this, but if you did have this trade on, this would be a time to make a decision. A lot of times if I have the short spreads on that got the momentum to the upside, they've had a strong earnings report. They were a little bit worried about Microsoft stealing some of their cloud space. Well, their earnings report kind of showed that they're still strong in that space, and things are rocking and rolling based off of 2 quarters ago. So forecasts look pretty good in Amazon. We got some upside momentum. They just did a big deal today. So I would look to roll it. And all you would do is close this and roll it up to a little bit closer. So you take the dollar profit. Right now, it is trading for 88 cents. You're actually up more than a dollar 10, and then roll to the just below. So 252 and buy the 247. That would be the adjustment that I would look to make on the 14-day trade. I'd probably keep it there. I wouldn't even go out to the 18-day. I would keep it at the 11-day, and I would make that move. Now, on the other side of things, oil is, they're talking about oil possibly having a glut of oil. And so oil prices might be going down, but I haven't actually looked to see what Chevron is doing yet. Let's see. CVX. Markets are flat. VIX is still a little bit elevated. Yeah, Chevron is down today. I think a little bit more on that news. So now we have a situation in Chevron. Yeah, we're down 2.5%. Chevron, what do we have in this position? We have the 157.50 and 152. 157.50, 152, 14 days out. We put it on for 150. And let's take a quick peek at this one. 157, we're selling that one, and then 152, we're buying that one. 273, almost double on this scenario. All right, so we'll probably adjust this one. I don't want, because it was the reaction to the news this morning about oil prices. I would watch it and maybe think about adjusting it. You can always, my general rule, if we put it on for 150, would be to close it at down 150. We're at 280 right now. And so either you close it or you roll it or you turn it into something else. And our turning it into something else means that we would end up selling a short spread and turning this in just to a standard butterfly. It's a $157 stock. It doesn't have a lot of vol, which makes it a little bit tough to make the adjustment. 14 days, but we'll look at that one on Wednesday once again. So those are the two major ones. Both of them could possibly be adjusted. And now we're going to look at Uber. And so for Uber, if I take a quick peek, well, let's look at Rivian since I have it up. Rivian's going to be announcing on the 4th. So right around the corner here tomorrow. As a matter of fact, I think it's tomorrow morning that they're going to be announcing. And we're just in this period of chop, in this period of consolidation. Low end is all the way down here around 10, high end up here around 17. So this is the 1-year chart. Stock has basically gone nowhere. But you can make the argument that this is a head and shoulders pattern and the entire year. And it's a elongated pattern. So something's definitely got to give around their earnings that's coming up. You see that we're down a little bit probably on Ford news. I mean, it's down 20 cents, but it's still 1.5%. So leaning bearish in this instance, heading into that earnings report. All right. So that trade, we will just very simply buy a put. I don't mind doing a put spread if you want to hedge some of your risk. You don't think that, okay, so if you look at the chart, you don't think it could get down below the 10. You can sell the 10 strike by doing that. But I think I just want to buy the put outright. We're going to give it a little bit of time. We're going to go out 32 days. We're going to go to December. And that's mainly because we're just going to buy the put outright. So if I'm buying a put outright, I don't mind erring to the fact that I'm going to buy more time. Now, the issue there is that you can't buy as many contracts. So like if you had X number of dollars that you were going to allocate, no more than usually in my speculative portfolio, I would never want to do more than 2% of the portfolio on a 100% earnings play. You know, like the Amazon trade to me isn't a speculative trade because we're not doing it around earnings. We did it after earnings. This is 100% about the earnings. And if you see this is fairly inexpensive. You see that it's at $14 right here. We got the implied volatility at 770 right now. So we're looking at least with the market at $3, we're looking at about a $2 move to the downside. And today we're down 19 cents, and that's 1.36%. So that's over a 10% move is the possibility after the earnings report. And so in this instance, we're going to end up buying the 14 strike put, and we're going to pay 150 for it. It's 150 by 140. We could probably work it a little bit, see if we could get it in at 145, but quite simply, that is going to be our trade. 145, we'll put it in at the midpoint. We'll send this to the what if calculator just to save it. If you want to sell the 10s, they're selling for like 20 cents. It's nothing to sneeze at. You could say, I don't think it's going to get that long, but here's the problem. If I'm going to do that, I'm going to sell something against it. I don't want to go out 32 days, because if you get that move to the downside, the market, then the 14 strike put wants market to go down. The 10 strike put doesn't want the market to go down. So you get to move to 10 with 32 days remaining. And this thing that's trading for 150, guess what? It's probably going to be trading for about 150. That 10 strike put will. Well, vol's going to come off a little bit, but it'll become the at the money option contract after that earnings announcement. So if I'm going to do longer trades and I see that this premium is here, I'm going to lay down until the urge goes away, right? I'm willing to give up that 20 cents for the potential delta move if Rivian does actually move 2 points to the downside. And it could move more. We don't know at this point in time. If you were thinking about doing a spread, you would come and maybe look at the November 11th, go 11 or the 14th, 11 days out. But then you look at the 10 strike, and then that's not trading for anything. So then you look at the 11, you're still not getting anything. Then you look at the 12, and you're looking at 28 cents. And now you're only talking about 2 points, which is the expected move. And then you say, nah, I don't think I want to do it either. So that's my whole process, and it's always different. The value of the underlying stock matters so much to go along with the implied volatility, obviously, but the value of the underlying stock is always a consideration in the strategy that you're going to use. So when I think about questions that I've received through the many years of teaching options, one of the biggest one was always, what's your favorite strategy? And it sounds like a cop-out, but it truly depends. It depends on the market conditions. It depends on the price of the underlying stock. And, I guess you could say my favorite strategy in general is skip strike butterflies, or skip strike or butterflies in general, open wing, skip strike, regular butterflies. But that also means that I actually look for stocks that it applies to, right? So I like to look for stocks that are trading well over $100. The more the merrier. A $200, $300 stock, those are always good stocks, because you get premium just from the price of the underlying, and then you throw in something volatile, and then you got something you can work with. You got something that you can manage as far as the volatility and the strikes are concerned. So here we're buying the 14 strike, paying 150 for it, and that's going to be our first paper trade heading into Rivian's earnings tomorrow. Easy for me to say. Next, what if calculator. All right, Uber. So Uber's $100 stock, good volatility that's in it. And so let's send this one to the what if calculator. Plot that one on in there. And we'll talk a little bit about, we're at 97.50 from 99 up to 104. So we got 5 points of upside. And then our second spread in our butterfly is only 2 points wide. So as opposed to a long call spread where you buy the 99 and you sell the 104, we're going to sell an extra 104, and then we're going to buy an alternative of 106 as protection. But if we did the standard butterfly, we'd be all the way up here at about 110. But then we would need it to stay within the range. It would be cheaper because you'd be further out of the money on your protection. So you'd have to pay less for this option contract. But the trade-off is that you don't have this nice potential gain if the market does go up. So if the market goes up beyond 106, the maximum that we can make on this trade is 176.50, which is the difference between the width of the two spreads. Okay, so 104, pointing to the bottom half of the screen here, 104 minus 109 is $5. That's the long spread that makes up the our butterfly. This is our workhorse. This spread is what can make us money if our forecast is correct, from 99 to 104. Then our short spread, which helps pay for the long spread, offset some of the risk, is from 104 to 106. So we are down. So that's 2 points on that. 5 minus 2 means 3. 3 minus the net debit paid is the maximum that we can make up here. Okay. If we go out at 104 exactly, we can make $375 approximately. These are, obviously, I got to get the cursor right on it to get the perfect numbers. But if you look right here, this is at expiration. That's what it would be looking at, about $375. Over here, $176. If the market does go down, if it goes down, our maximum we can lose is the net debit that we paid for the trade. So now if we go back and we look at Uber and we wanted to buy the 99 strike outright on the, well, let's send it to the ticket here. Oh, this is it, 11.7, 11. Oh, well, this is still Rivian. That's what's going on. On the November 11th earnings report. So here we go. November 7th, expiration 4 days away. We're looking at let's make it 120. Let's go right to 120. We're froze at this point in time. Yeah, I'm froze. I can't move. Okay, so 118 on the Uber open wing butterfly, November expiration, 4 days away. And there it is. It's finally in there. I can't see my strikes yet. There we go. There's the 99, 104, 106. And this is, and also I guess worth noting is that we're saying it's got to make the one standard deviation move, right? The probability is a 20% chance that it gets to this level. There is a 25% chance of it stopping at 104. And then obviously if it makes the move to the downside, that is our max. That's where our max loss is at. 99 strike 280, and well, let's go 98. Okay, 98, 325, and 3. So 7. Yeah, we're looking at about a 8 or 9% move is what the expected move is at. We're right at 100, and we're looking at about $8 as the expected move if we bought the at the money call and the at the money put. So we're looking at about an 8% move is what the marketplace is expecting. $8 would put you right at from 98 on up would go to right around 106 in that instance. So we're right about where that expected move is at. And that's what the strikes are based on. The marketplace says that this is a possibility that the stock could move up to the 106 and 104 level. We're within the range, right? Any questions so far on this trade? So this is an open wing butterfly. I apologize that we've slowed down a little bit on the trade. Let's see. Or why my internet slowed down. And here's the what if. Let's go back. Come on. All right, there we go. Now we're back to the what if calculator, and that is our outlook, and that's our forecast. And we'll come back on Wednesday and we'll look at this trade. Chevron will probably adjust, kind of hoping that we get a little bit of a bounce back today. I think that was a little bit of a strong reaction to the downside. And if we don't, we'll make an adjustment on the trade. And then also on Amazon, we'll look at that trade too. And that'll be it for this episode of Options Guide TV. We'll see you this Wednesday, 11 a.m. Eastern Time, inside the hub, hub.tradier.com. So please set up a profile. It's 100% free. There is no in-app purchases afterwards. And you have access to all the great speakers and the great lineup that Tradier has put together. So see you this Wednesday, 11 a.m. Hope to see you in the hub.
You know how the financial world goes. Here comes the buzzkill. Please make sure to take some time to read this boring disclaimer. We will owe you one.